Alright, this first question talks about direct materials cost of $6 per unit for 100,000 units for a total of $600,000 of direct material cost, and they're asked to identify what the standard cost and budget cost is. If you recall from the slides, we talked about standard cost being a unit cost versus budgeted cost being the total cost for standard units expected for that year. So if we look at $6 per unit, times the 100,000 units, you will have $600,000 as your budgeted cost. Therefore, your standard cost is $6 per unit, being option A. Alright, we're given a situation where we have Oxnard Industries producing a product that requires a bunch of materials as indicated in the question here. We're given some freight costs, some purchase costs, hourly salaries, as well as standard production time. So we'll go through the four charts to determine the calculations. So let's just start with the first item. Purchasing price per pound, if we look at our details, is $2 per pound, but there's a 2% discount. So if we go equals the $2 times 1 minus the discount being 2%, we have 98% of the original purchase price. So our net cost per pound is $1.96. If we add in freight costs of 10 cents per pound and handling costs of 7 cents per pound, we have a standard direct materials price per pound of $2.13. Moving on, we have required materials per unit. We're told that we need 2.6 pounds per unit. We need to allow for waste of 0.3 pounds and spoilage of 0.1 pound, so we have a standard direct materials quantity per unit of 3 pounds. Moving on to the hourly wage, we will start with a $12 hourly wage, but we're told that there will be a raise coming in shortly for 30 cents an hour. We have payroll taxes estimated at $1.20 per hour and fringe benefits, which are typically health and dental or life or LTD or short-term disability, other type of employee-related benefits are $2.40 per hour. So we have a standard direct labor rate price per pound of $15.90. The last schedule is the production time per unit. We're told that it's typically 1 hour, but there's rest period of 0.2 for every unit and allowance for setup and tear down of 0.1, so our standard direct hours per unit is 1.3. Alright, we're moving on to question 3, where we're given some standard quantities to produce 1 unit, which includes 2 pounds of materials. I've indicated the materials being 2 pounds per unit at a rate of $2 per pound. We have the cost of labor being 1.5 labor hours at $7 per hour. And our cost of overhead is based on direct labor hours, so it's the same 1.5 hours, times the $8 direct labor hour. If we go through the math and calculate the units times the rate, so we have 2 pounds times $2 per unit is $4 cost of material. 1.5 hours times 7 hours is $10.50 for labor costs. 1.5 hours times the $8 per unit of overhead equals a $12 cost of overhead. So our standard cost in this situation would be $26.50. Alright, question 4, we have a company that planned to use 1 yard of plastic per unit, budgeted $81 a yard. However, the plastic actually costs $80 per yard. The company actually made 3,900 units, but it planned to make 3,300 units. Total yards used for the production were 3,960. How much were the total materials variance? So in this case, we're told the actual materials was 3,960. The actual cost per unit was $80 per yard. So we have a total cost of 3,960 times 80 being $316,800. If we look at the budgeted material, this is where you have to look at standardized costing. They expected to use 1 yard and it was 3,900 units produced. So we have 3,900 budgeted materials planned, and the budgeted cost per yard was $81. So our total cost in this case, 3,900 times 81 budgeted for $350,900. Because the actual exceeded the budget, we have a $900 unfavorable variance in this situation. Alright, question 5, we talk about a company has the following per unit standard for its products: 2 pounds of direct materials at $4 per pound, and last month 1,500 pounds of direct materials were purchased for $5,700. So we want to know what the materials price variance was in this case. So our actual materials used, we're told, is 1,500 pounds. Our actual cost per unit we have to calculate, it's the $5,700 paid divided by the 1,500 pounds. So we have total spend of $5,700. The actual materials used is the same for the budget calculation times the standard cost per pound, which was $4. In this case, because our budget was greater than our actual, we have a favorable $300 variance as the budget was higher in this case. Alright, we have question 6 now, where we're given per unit standards for direct materials of 2 gallons at $4 per gallon. Last month they used 11,200 gallons. That actually cost $42,400, and they were used to produce 6,000 units of product. Direct materials quantity variance for last month was what? So in this case we need our actual materials used, so we are told that we use 11,200 gallons. The standard cost per unit is our $4, standard cost. Our budgeted materials used, and in this case we produced 6,000 units, so we have 6,000 units, and we're told that the standard but the budget materials was 2 per unit, so we have 12,000 budgeted materials, and the budgeted cost per pound being $4. So our budget was greater than our actual spend, so in this case we have a favorable variance of $3,200 for the materials quantity variance. Alright, question 7 talks about per unit standards for direct labor being 2 direct labor hours at $15 per hour per unit, and we produced 1,800 units where the actual direct labor cost was $48,000 for 3,000 direct labor hours worked. So we're asked to determine the direct labor variance. In this case, we had 3,000 hours used, and our actual price or rate, we have to take the $48,000 spent divided by the 3,000 hours to get a $16 actual price per hour, total of $48,000 spent. On the budgeted hours used, we said that it typically would take 2 direct hours, so 2 times the 1,800 units produced would be budgeted hours at $3,600. In this case, we're told that the budgeted price is $15 per hour, not $153. So our total budgeted labor was $54,000 for 1,800 units. In this case, because our budget exceeds our actual, we have a $6,000 favorable variance in this situation. Alright, for question 8, we're told that the standard rate of pay is $20 per hour. We'll actually populate that right into our formula, $20 per hour. And the actual direct labor payroll was $117,600 for 6,000 hours. So we had 6,000 hours, which fits both sides of the formula. And we had a total of $117,600 over the 6,000 hours consumed for an average hourly actual price of $19.60. In this situation, again, our budget exceeds our actual, so therefore we had a $2,400 favorable variance for the labor price rate. Alright, for this one, we're told that there was a favorable variance for this organization for price variance of $4,000, and they purchased 20,000 pounds of materials. So we have to do a little bit of backwards math, and the fact that they have actual materials of 20,000 pounds being consumed, and that we're told that there's a $4,000 favorable variance, which means the budget exceeded the actual. Simplest way to do this is to take the $4,000 variance, divide it into the 20,000 units, so we had a standard cost per pound variance of 20 cents per unit, which is option B in this case. Alright, for question 10, we're told that a company used 40,000 gallons of materials, which they paid $7 per unit, so they spent an actual amount of $280,000, being 40 times 7. They had a materials price variance of $80,000, which is favorable, which means the budget exceeded the actual. And we're asked to calculate what the standard price per gallon was. So in this situation, to get our budgeted amount in total, we would add the variance to the actual, so we had a total budgeted amount of $360,000. To get our standard cost per pound, we would take the $360,000 divided by the 40,000 actual materials used, so we have a standard cost per pound of $9. Per gallon. Alright, question 11 talks about the Clark Company producing a product with a standard direct labor cost of 2 hours at $18 per hour, and in July they made 2,000 units using 4,200 hours at $18.30 per hour. And in this case we're asked to calculate the labor price variance. So if we look at the actual hours, we have 4,200, and that you will use on both sides. And we have the actual cost of $18.30 per hour, giving us a total of actual spend of $76,860. Our standard price was $18 per hour, given a budget of $75,600, which tells us that in this case we have an unfavorable variance of $1,260 unfavorable as it exceeds the budget. Alright, in question number 12, we have a company income statement where they report gross profit of $55,000 at standard costing, so we'll add $55,000 for the gross profit at standard. And they have the following variances. So if we look at materials price, they had $420 favorable. They had materials quantity $600 favorable. Labor price $420 unfavorable. Labor quantity $1,000 favorable. And overhead $900 favorable. In this case, any time that there's a favorable variance, we will add it to the gross profit at standard, and unfavorable will reduce the gross profit at standard. So if we add the favorables less the unfavorables, we have an add to our gross profit of $2,500. So our gross profit actual in this case is option C, being $57,500. Those are all the examples we have for Chapter 15, being standard costing and balanced scorecard, but reach out if you have any specific questions or other comments to ask.